Hello everybody. So in today's video, I'm doing a little bit of a throwback to back to the day where I used to do my most undervalued videos. With one tiny difference, today I would like to highlight today the rule of 40 stocks that achieve a rule of 40 or close to it at a 35 for Castle Bioscience here. And these stocks are not selected on the basis of quality, although I like a lot of them. They're selected in this spreadsheet because they are cheap, inexpensive. But of course, there's many of the stocks here that I find qualitative. And in my full spreadsheet, I already do a initial screening, and so I have more than 200 stocks. These are the cheapest on the EV over GP over RG, enterprise value over gross profit over revenue growth. Don't forget, that doesn't mean you have stocks that are just as cheap on this, but that don't quite achieve a rule of 40. So not all the stocks are included, but at least those that I find the most undervalued growth stocks right now. So let's get started. And first of all, an observation. The market really doesn't like health tech or like anything that's health edgy, like health different. New business models, new tech, really doesn't like that. Look up at an ETF like ARKG and you'll see that they don't like it. The market doesn't like China, and that may be warranted, that may not be warranted. I don't know. I do not own Chinese stocks, but that's the market. And the market does not like stocks that have been attacked by short reports or that lost their auditor. That would be SMCI. The market doesn't like SMCI. I also want to highlight how cheap these stocks are, and feel free to pause the video. This is what the Max 7 stock look like on a similar metric. So you can see on an enterprise value over gross profit over revenue growth, Max 7 looks nosebleed expensive, aside from maybe NVIDIA. NVIDIA is the cheapest Max 7 per my numbers here, and the highest rule of 40, but otherwise you can see it's not uncommon for these stocks to get around a 1 or a 0.7 or a 0.6 in these metrics. And so that really is to highlight how much cheaper these stocks can be. And so that's quite impressive in many ways. And note how there is a delta between BioStem, which is my cheapest stock that I want to present today, and say SMCI. I mean, I could rightly say that SMCI is 14 times more expensive than BioStem on a growth adjusted basis here. So let me just go ahead and get started and tell you about BioStem. BioStem, they collect placentas and they turn them into bandages and into wound care products. The product is taking the world of wound care and wound care specialists by storm. The company has a plan for a reimbursement. 2 of their products are getting reimbursed by Medicare. 2 of the other ones are trying to get back on the list. This company is predicted to grow at 80%. What is very special about BioStem, it's a gross margin. That's the real number right there of 97% gross margin. EBITDA margin is 10%. So when I compute that, I get a forward revenue growth number, EV, enterprise value over forward revenue growth of 0.45. So not even 50% of future sales is what this stock is trading at right now, with an enterprise value of 240 million, and they have right now 302 million in sales. So they already have more revenue than the value of this company. It's a 0.01. It's very cheap. Moving on to the second cheapest, which is also in the health sector, but this time is a business model disruption. It's LifeMD. LifeMD is what I would describe as a digital family doctor or a digital doctor that has a subscription, but you don't have to take the subscription. They also do like a single visit. They sell you a visit for $129 for a doctor office visit, or you can get a monthly price for $39 a month. You get 1 visit a month, and they have a team of about 50 doctors that are hired, and they all work in New York City, and they have full-time doctors working for them, and what they do all day is just give these doctor visits. And LifeMD, also interestingly, they're launching their own pharmacy now, copying IMS, and they're going to have their own pharmacy and fulfill their own product, because why would you want to send the business to someone else when you prescribe? You have the business, so why not keep the business in-house? And so that's what LifeMD is doing. LifeMD is dirt cheap as it is. If you look at the full number of revenue growth, it's dirt cheap as it is. 0.038 is how much I'm paying for that growth, and they break through the rule of 40 at a 41. So the company is dirt cheap as it is. But it gets even cheaper if you remove work simply. So what I did in that second line right here for LifeMD is I removed the valuation, supposed valuation of work simply from the enterprise value, and I remove the revenue of work simply from the revenue line. And so if you remove work simply, which grows much slower than the main health business, and you were to assume they sold work simply, which would be a catalyst for that stock, then you get forward revenue of 53%, gross margin is still 89%. I couldn't really get into the details. Same for EBITDA margin, couldn't get into the details, but I'm assuming doctor visits are more profitable than work simply, but maybe that's a fake assumption. Maybe that's a wrong assumption. I don't know. Still, the point is, if you remove work simply and you assume they sell it, and sell it they will because it's unrelated to the main business, it's trading at a 0.018. So 80% more expensive than BioStem, but still absolutely dirt cheap. This company is quite special in how cheap it is. Oh, I forgot one. So if you're on the Patreon, you know which one I forgot. I forgot Pinjojo. So Pinjojo should be in there. Pinjojo is actually cheaper than Castle Bioscience, but that's okay. So we'll forget about Pinjojo for a second. So Castle Bioscience, they do cancer screening. They have a product called TMDX. How cheap is this company? It's a 0.07, so it is dirt cheap. How much am I paying for that growth? Next to nothing. Rule of 40 is not quite there yet, but it will be. Noteworthy to say it's the slowest growing company of the bunch at a predicted revenue growth of 25%. It's funny to think that 25% is the slowest on the bunch when, if you compare a company 25% growth compared to the S&P 500, it's still a very high growth stock. But compared to what I compared to, slightly lower growth. I do not own that stock, by the way. I own BioStem and I own LifeMD. Okay, let me move on to another stock that I don't own, and it is Luckin Coffee. Luckin Coffee is very cheap in my screeners. And actually, if you look at the valuation per coffee shop in China, it's something like $250,000 valuation per coffee shop. Compare this to, say, a Cava, which is valued at something like $30 million for a Cava shop or a Cava store, like food store. So it's the cheapest stock in my food and beverage space, and it is giving Starbucks a run for its money in China. Starbucks has lost its way in China, to the best I can tell. Luckin Coffee resonates much more with the Chinese consumer, and they may be called Luckin Coffee, but they do much more than coffee, and most of their sales are actually not coffee. And how much do you sell? You sell a 0.081. You pay, EV over GP over RG, you pay a 0.081, so that's dirt cheap. Rule of 40 is a 49. Now, Luckin Coffee may still be suffering from the stigma related to their accounting issues. So I don't own Luckin Coffee, but I can't help but notice it in the screener. It is very, very cheap. Another stock, which is headquartered in California, but that a lot of investors consider to be Chinese, is called Gigacloud. Gigacloud is a drop shipping third-party platform that allows you to ship directly from the manufacturer to the end consumer via your website, via your Instagram, your listing on Amazon, or whatever you do in drop shipping online. Or you could even have a physical store and just use Gigacloud to ship direct from the manufacturer to the end consumer. You may wonder what they specialize in. Well, they used to specialize only in furniture, but now they do anything that's big. Any big, bulky item is what they specialize in. And they are a logistics company, first and foremost, coupled with a platform, with a two-party platform with third-party sellers and then buyers who ship to the end seller. I don't own that stock, although I find that company interesting, and I've covered it before in depth on the channel. Let me move on with HIMS. So HIMS is a channel favorite. HIMS got a little more expensive, but it's still under 0.1. You may remember the early days of the channel when it was trading at a 0.06 or a 0.05. HIMS is my favorite stock out of all of the stocks that I briefly mentioned today. Absolutely my favorite. It's a major position for me. It's a top 5 position for me. I think this company is still highly misunderstood by the market. Currently waiting for opportunities to add. Hopefully we get Ozempic off the shortage list. And when it's off the shortage list, maybe the stock takes a drop 15-20% and we get a buying opportunity. Right now, the stock is still stuck in this cycle of fear related to the GLP-1s, related to semaglutide, whether semaglutide is going to be off the list or not. It seems like semaglutide is still in shortage. Semaglutide is still on the list. So, the market right now is kind of in this holding pattern, waiting to see what's going to happen. If you're a long-term investor in HIMS like me, that doesn't matter because GLP-1s, if you're a long-term investor, it's only 10% of the business. And the business is, ED is much bigger for them. Hair loss is bigger for them. And HRT, hormone replacement therapy, starting with menopause, is also, in my view, going to be bigger for them than weight loss. So this is a bigger company in the making that I think a lot of people give it credit to. Moving on to TransMedics. TransMedics got criticized by a company who maybe short the stock. Anyways, there was a major rebuttal from the company and from the CEO himself at a JP Morgan healthcare conference. And the CEO pounded the table, telling us that they were going to achieve, between 75 and 80% growth in 2025. So next 12 months, the CEO yesterday, 2 days ago when this video was published, was pounding the table, saying they're going to do between 75 and 80% growth, and you can bet on it, is what the CEO was saying. So I take the CEO at his word, and I'm putting 77.5% revenue growth, forward revenue growth in my spreadsheet, so that rounded it up to 78. But the point is, with that number going forward, TransMedics looks pretty darn cheap. How much am I paying for that growth? I'm paying an enterprise value over gross profit over revenue growth of a 0.125, and the rule of 40 is also outstanding at a 90. I own TransMedics. I like TransMedics, and I've covered it before on the channel. And the last stock, which I also own, it is SuperMicro, SMCI. The market doesn't like SMCI right now. It still has stigma from the quick NASDAQ addition and the quick NASDAQ removal. And it has stigma from the auditor leaving and the new auditor coming in, but they have a new auditor now, and the revenues were not restated. So I really don't understand why this stock is still in the dumps. I really don't get it. I mean, to me, it's short-term movement. Typically, when you have these issues, they tend to be remembered by investors maybe 12 months to 24 months. I usually say 18 months. So me, I'm a long-term shareholder, so it really doesn't bother me. These issues will fade. The bad impression that it left will fade, and we get a major discount compared to where it was trading at the beginning of 2024. It is still, or at least they still claim to be more than 3/4 of the liquid-cooled data center market, and they've really ramped up the liquid cooling data center offering. And of course, Blackwell, which NVIDIA is betting big on, is going to need to have liquid cooling. So a big area for growth for SuperMicro SMCI is going to be providing these racks and providing this cooling equipment for the addition of data centers that are liquid cooled. If you follow Elon Musk, the giant XAI Memphis data center, half of that data center was built by SuperMicro. The other half of the data center was built by Dell. The problem is that Dell is not a pure play. SuperMicro is a pure play on cooling. And there's another company, right? Vertiv is the other one in the cooling space. But boy, oh boy, isn't Vertiv 5 or 6 times more expensive than SMCI? I will take the risk when I see those cheap numbers. Happy to own it. And anyways, this was not financial advice, not investment advice. This is just entertainment. Please like, please subscribe. Thank you for watching and have a wonderful, wonderful day.